I want you to imagine a scenario for a second.
All right.
So you're watching the financial news, right? And this highly influential CEO publicly announces that they are firing nearly half of their entire workforce.
Wow, half.
Half. And we are not talking about a company that's going bankrupt or, trying to save a sinking ship.
Yeah.
They are doing this specifically because they are integrating AI.
Right.
And then imagine that same CEO looking dead into the camera and predicting that the vast majority of their competitors are going to do the exact same thing within a year.
I mean, that literally sounds like the opening scene of a dystopian sci-fi movie, like the kind where, the robots take over by Act 2.
Yeah, exactly. But this isn't a hypothetical movie script. This actually happened. In February of 2026, Block Inc. laid off nearly half of its 10,000 employees.
Right, I remember that.
And CEO Jack Dorsey made that exact prediction. He went on record saying the majority of companies would reach the same conclusion about AI in their workforces within the next year.
Which is just wild to think about. And it perfectly brings us to the core of our deep dive today. We're looking into this massive economic contradiction highlighted in a paper we've been reviewing called the AI automation paradox.
Because the paradox is just massive. If companies fire human workers to save money on labor, they are simultaneously eliminating human consumers.
Exactly.
Like, you simply cannot buy consumer goods if you don't have a paycheck. So, okay, let's unpack this. What is actually going on here?
So what we are looking at is what the research describes as a structural market failure.
Okay.
The framework suggests that rational companies, even companies with perfect foresight, who completely understand that mass layoffs destroy their own revenue base, over time they are mathematically trapped.
Trapped in an automation arms race.
Exactly. They can't stop themselves. So our goal today is to figure out why this happens, how the trap works, and, look at what evidence-based solutions actually exist.
Right, but before we get into the trap itself, the source material makes it really clear that we have to understand the scale first.
Yeah, the sheer speed and scope of this current AI displacement wave, it's totally different from past tech revolutions.
Because we aren't just talking about, installing robotic arms on an assembly line anymore.
No, not at all. We are talking about the automation of cognitive labor. I mean, just in 2025 alone, over 100,000 tech workers were displaced.
100,000. And it's the nature of those jobs that really shifts the paradigm, right? We're looking at customer-facing operations, complex back-office stuff, and especially entry-level tech roles.
Right.
Like, the examples in the research are staggering. Salesforce reportedly replaced 4,000 customer support agents with agentic AI systems.
Yeah.
And then there's Cognition's Devon tool.
Oh, yeah. That is such a critical example. Devon isn't just a digital assistant. The data shows this AI allowed a single senior engineer to output the work that used to require a 5-person team at major firms.
Like Goldman Sachs and Infosys.
Exactly. It's a massive force multiplier.
And if you're listening to this right now thinking, well, I don't work in a tech startup or a massive finance firm, so I'm totally fine. There's a study cited in our sources that is pretty alarming.
Oh, the 80% figure.
Yes. It estimates that 80% of U.S. workers hold jobs with tasks that are highly susceptible to large language model automation. 80% of the workforce is exposed to this.
What's fascinating here is how the researchers explain the economic weight of that number. They point to this concept called reinstatement effects.
Reinstatement effects.
Yeah. Historically, when new technology displaced workers, it almost immediately created new tasks and occupations. Like, the lost jobs were replaced by new ways for humans to add value. The labor market just always adapted and grew back.
Okay, so it feels a bit like a lumber company realizing that clear-cutting every single tree will ruin the forest forever, but they keep their chainsaws running anyway because the wood is incredibly cheap right now.
Right.
And they just assume the forest will heal itself like it always has.
That analogy actually maps quite closely to the paper. Historically, the forest did grow back. But the researchers argue that with this specific AI wave, the automation is targeting entry-level and cognitive roles so broadly that it completely breaks that traditional cycle.
Because those entry-level roles are where you actually learn how to do the job.
Exactly. It's where workers gain the on-the-job learning they need to progress in their careers.
So if an AI is writing all the basic code or, drafting all the standard legal briefs, humans don't get the practice of doing that repetitive foundational work.
They never build the skills.
Right. They can't become the senior engineers or the senior partners. So to go back to the lumber thing, they're cutting down the saplings, not just harvesting the mature trees.
Yeah. That's spot on. And the downstream effect of that, according to the research, is a severe drop in the income replacement rate. When those pathways vanish, workers lose the mechanism for human capital accumulation.
They can't level up their income.
Right. Even if they find new jobs, the data suggests those jobs are often in sectors with much lower growth trajectories. So the worker doesn't just lose their current salary.
They lose the compounding future earnings for their entire life.
Exactly, which drastically diminishes their lifelong purchasing power as a consumer in the broader economy.
Okay, so if the end result is this very obvious drop in human purchasing power, I just keep coming back to a basic behavioral question.
Which is?
If Jack Dorsey sees this coming and the broader market sees it coming, why keep accelerating toward a cliff everyone can clearly see?
Right, and this is where the theoretical framework comes in.
Right.
It shifts the conversation from what is happening to the underlying math driving the behavior. They formalize this concept called the demand externality.
The demand externality. Okay, let's break that down. From what I gathered in the text, it's basically this massive diffusion of responsibility.
Yeah, pretty much.
Like if I'm running a company and I decide to automate a huge department, I immediately capture all the cost savings. My quarterly margins look fantastic.
Your shareholders are happy.
Very happy. But the penalty for doing that, meaning the lost purchasing power of all those workers I just fired, that doesn't hit my balance sheet directly. I am spreading that penalty across the entire market.
You are hitting on the exact friction point. A worker laid off from Block doesn't just stop spending money at Block.
Right.
They stop buying groceries at the local market, they cancel their software subscriptions, they drop their gym membership.
So if my company has, say, a 1% market share in a highly competitive sector, I only bear 1% of the demand destruction I just caused.
Exactly.
The other 99% of the financial pain is essentially exported to my competitors. And because I'm only feeling a tiny fraction of the pain, my mathematical incentive to automate is just overwhelming.
And the framework suggests that because of this dynamic, firms in competitive markets will automate at roughly twice the collectively efficient rate.
Twice the rate. Wow.
Yeah. The authors point out this creates a classic deadweight loss. It's not just a transfer of wealth where the corporate owners win and the workers lose. The mathematical models actually indicate a scenario where both owner profits and worker incomes eventually fall below their optimal levels.
So everybody loses.
Everybody. It's pure economic waste. Both the shareholders and the workers end up worse off than they would be if the automation happened at a measured cooperative pace.
See, I struggle to buy the idea that these corporate boards are just blind to this. We are talking about highly educated tech leaders. If they know this hurts their own long-term survival, I don't understand why they don't just collude.
Form an agreement, you mean?
Yeah. We see companies quietly align on pricing strategies or standardizing hardware all the time. Why not just get in a room and agree to slow down the AI deployment to protect their consumer base?
Well, the economic theory addresses that directly. The idea of private parties negotiating voluntary agreements to solve negative externalities is called cohesion bargaining. But the researchers detail several specific reasons why their models show cohesion bargaining completely failing here.
Why wouldn't it work?
The first barrier is that full automation presents itself as a dominant strategy.
Meaning what, exactly?
In game theory terms, it means mathematically, regardless of what your competitors decide to do, your most profitable short-term move is always to automate.
Always.
Always. The second barrier is the multilateral nature of the damage. You're hurting everyone on the market just a little bit, which means no single competitor has enough financial leverage to force you to the negotiating table bilaterally.
Okay, so the short-term incentives are too strong and the damage is too spread out. But what if they did? What if they formed a massive coalition? How would they enforce it?
They couldn't. And that is the third point in the framework. AI integration is largely non-contractable.
You can't verify it.
Exactly. You simply cannot verify a rival's internal operations. If two massive tech firms agree not to use AI agents to write internal code, there is no realistic way to audit that. The cheating is virtually invisible.
Wow, that makes sense.
Furthermore, the transition is irreversible. The sunk costs of overhauling your infrastructure to integrate AI are colossal. Once a firm commits to that architecture, they can't easily roll it back just to punish a competitor who broke the gentleman's agreement.
So even if every CEO met in a boardroom, shook hands, and agreed to slow down the pace of automation, the second they left that room, the financial incentive to secretly break the agreement is mathematically irresistible.
The models show that a grand coalition simply cannot hold under those conditions. The authors emphasize that this isn't a failure of communication among executives. It is a textbook market failure.
Okay, so if the companies are structurally incapable of regulating themselves, the public naturally starts demanding policy interventions.
Right. They look to the government.
They look for a safety net. But as we transition to the solutions evaluated in the research, the authors argue that the most popular proposals currently being debated actually completely miss the core economic mechanism of the problem.
Yeah, the paper suggests many popular policies treat the symptom, which is the lost income, but fail to address the disease, which is the flawed incentive structure at the corporate level.
So let's start with universal basic income, or UBI, giving every citizen a flat, unconditional monthly payment. The research reviews pilot programs in places like Finland and Kenya, right?
Yes, exactly.
Because to the general public, UBI feels like the intuitive answer to AI job displacement. If machines take the jobs, you tax machines and give humans a baseline income to survive on. Why do the researchers argue that UBI fails to solve the paradox?
Well, the authors do acknowledge that UBI does something very vital. It raises the consumption floor.
It keeps people out of poverty.
Right, it keeps individuals out of abject poverty and maintains a baseline of aggregate demand in the broader economy. But the paper's analysis focuses on the firm's specific mathematical decision to automate a given task.
Okay.
Because UBI is unconditional, meaning a worker receives it regardless of whether they are employed or displaced. It does absolutely nothing to alter a specific company's incentive margin. The cost savings a firm realizes by replacing a human with an AI remain exactly the same, with or without UBI in the background.
The company still races toward the cliff because their internal ledger hasn't changed. They just operate under the assumption that the government placed a net at the bottom of the cliff.
Exactly. But the models in the paper actually suggest an even more counterintuitive outcome. UBI might actively widen the externality.
Wait, really? How does providing a guaranteed income make the automation arms race worse?
Because UBI artificially raises the overall baseline of demand in the economy, it makes the total market appear more profitable and stable. And according to the framework, this perceived stability attracts more competing firms into the market. Think back to that fraction we discussed earlier.
The firm with a 1% market share only bearing 1% of the demand destruction they cause.
Right. Now imagine UBI attracts a surge of new competitors, fragmenting the market further. Now there are 1,000 firms instead of 100. When a single firm automates a department, they now only bear 1,000th of the demand destruction.
Oh, wow.
The externality gap widens. The mathematical penalty for firing humans becomes even smaller, making the incentive to over-automate even stronger than before.
That is a fascinating unintended consequence. UBI might help people survive day to day, but according to this model, it inadvertently accelerates the specific corporate behavior that destroys the jobs in the first place. So if UBI doesn't fix the corporate incentive, what about corporate taxes? We constantly hear debates about implementing robot taxes or significantly raising corporate capital gains taxes.
Yeah, but the researchers draw a very sharp distinction between types of taxes. If a government simply implements a general capital tax, meaning they tax a company's overall net profits at a higher rate at the end of the year, the authors argue this just scales the entire bottom line down.
It just makes them less profitable overall.
Right. If corporate profit is taxed at 20% or 40%, the marginal calculation of whether to replace a human task with an AI task to save $1 remains identical. It shrinks their total take-home revenue, but it doesn't change the operational decision-making process.
Well, here's where it gets really interesting. There's an alternative approach mentioned in the sources, moving away from government policy and looking at structural corporate changes. The text brings up Amazon's Upskilling 2025 program and Spain's Mondragon Corporation.
Yes, Mondragon.
Mondragon is this massive federation of worker cooperatives where the employees actually have equity and profit sharing built into their contracts. If the workers own a piece of the company or if the company pays to heavily retrain them into new roles, doesn't that solve the purchasing power problem?
The research notes that these structural models definitely help significantly, but they still fall short of fully closing the externality gap.
Why is that?
Let's look closely at Mondragon and Amazon. Both organizations are highly effective at raising that income replacement rate. At Amazon, displaced warehouse workers were actively trained for higher-paying cloud infrastructure and AI management roles.
Right.
And at Mondragon, when assembly lines were automated, the displaced workers retained their equity in the newly optimized higher productivity systems, allowing them to share in the increased profits.
So their personal purchasing power was protected or even increased?
They recovered a substantial portion of it, yes. But the researchers point out a fatal flaw in relying solely on worker equity or internal upskilling to solve the macroeconomic problem. Workers do not spend 100% of their income within the specific sector that employs them.
Oh, right. An Amazon cloud engineer doesn't spend their entire six-figure salary exclusively buying things on Amazon.com. They buy cars, they go to restaurants, they buy homes.
Exactly. The demand is fundamentally multilateral. Even if a company operates with full profit sharing, when they automate tasks and displace traditional labor, some of that lost consumer demand inevitably leaks out and damages the broader economy.
So a bilateral arrangement between one single firm and its own workforce can never fully capture or replace the demand that is leaking outward.
Exactly. The residual gap, the externality, it remains a problem.
Okay, so we've looked at the failure of self-regulation, the critique of UBI as an accelerant, the inefficiency of broad corporate taxes, and the limitations of worker cooperatives. So what do the researchers actually propose? What mechanism aligns private corporate incentives with the public economic good?
This is where the research shifts from reactive support mechanisms to what they term proactive correction. And the core solution proposed in the paper is the implementation of a Pigouvian automation tax.
Okay, for those who haven't taken an economics class recently, let's define a Pigouvian tax in this context.
Sure, a Pigouvian tax, named after the economist Arthur Pigou, is specifically designed to be placed on any market activity that generates negative externalities.
Like a carbon tax.
Perfect example, a carbon tax levied on a factory for the pollution it pushes into the surrounding town. In this context, the paper argues for an automation tax that is not a broad tax on profits, but a hyper-targeted, per-task tax levied exactly on the automated systems replacing human labor.
So the government wouldn't be taxing a company simply for being successful or profitable? They are putting a specific calculated price tag on the precise action of replacing a human workflow with an AI workflow.
Yes, and the authors argue that the tax rate must be mathematically calibrated to equal the exact amount of uninternalized demand loss that the firm is pushing onto its competitors.
So forcing the true cost onto their ledger.
Exactly. If an AI agent saves a firm $10, but the models show it destroys $2 of aggregate demand in the broader market, the tax is set at $2. According to the research, this specific calibration suddenly aligns the firm's private incentive with the socially optimal rate of technological integration.
But wait, doesn't that inherently stall innovation? Like, if you tax the deployment of AI, aren't you just freezing the economy in place and preventing technological progress?
That's a great question, and the paper is very clear that the tax alone is not the full solution. The framework insists that the revenue generated from this Pigouvian tax absolutely must be aggressively recycled into rapid, high-quality retraining programs.
So the capital goes directly from the automated system that displaced the job into building a new, more advanced capability for the human who is displaced.
Right. And the researchers point to Denmark's flexicurity model as a real-world proxy for how this recycling works in practice.
How does that work?
Well, Denmark operates with high payroll taxes that essentially act as an implicit automation wedge. But crucially, the government uses that massive tax revenue to fund aggressive, sponsored retraining and direct job matching services.
Oh, wow.
The paper notes that when Danish firms automated heavy manufacturing, displaced workers were able to access funded retraining within weeks, not years.
Weeks? That's incredible.
Yeah, and as a result, their effective income replacement rate consistently stayed above 80%.
Because their income was rapidly replaced through transitioning into new, higher skill roles, the aggregate demand in the economy was protected.
Exactly. And the framework takes it a step further. As those retraining programs become more efficient and as the income replacement rate naturally rises, the actual demand loss in the economy shrinks.
Oh, I see where this is going.
Right. Because the Pigouvian tax is mathematically tied to the severity of the demand loss, the tax rate itself can decrease over time. The authors frame the Pigouvian tax as a transitional economic tool, not a permanent anchor. It is designed to buy the labor market the time it needs to adapt to the shock.
It's a system designed to fund its own obsolescence.
Beautifully put, yes.
That makes total sense on a macroeconomic level, but policy legislation usually moves at a glacial pace. The paper also highlights things individual organizations can do right now to build resilience, right?
Yeah.
There is a really compelling section on Volkswagen's Works Council and how they handle technological integration.
Yes. The researchers view internal governance as the necessary other half of proactive correction. At Volkswagen, they utilize a works council system, meaning labor representatives possess legal binding input on production changes.
Okay.
When VW management wanted to introduce advanced AI-driven assembly optimization, they were legally unable to just decree it from the executive boardroom.
They were forced to the negotiating table.
They had to be. They ultimately negotiated a 5-year phase-in plan. The researchers highlight that this wasn't about the workers blocking the AI. It was about tying the speed of the automation rollout to specific retraining milestones.
So they paced it.
Yes. The workers whose manual tasks were displaced were transitioned into funded apprenticeships for electric vehicle diagnostics. VW aligned the pacing of the technology with the realistic reabsorption capacity of their own workforce.
And the crucial distinction the researchers make is that this strategy succeeded because the labor representatives had legal co-determination rights. It wasn't just a voluntary courtesy extended by a benevolent CEO. It was a rigid legal structure that embedded human transition timelines directly into the corporate deployment timeline.
Exactly. And if we connect this to the bigger picture, building on that concept of dynamic pacing, the researchers also suggest the implementation of counter-cyclical controls.
Meaning the rules should adapt based on the current temperature of the broader economy.
Exactly. The framework suggests that during an economic boom, when unemployment is very low and displaced workers can easily transition to new roles, government should loosen the automation taxes.
Because the economy has the elasticity to absorb the disruption.
Right. However, during a recession, when alternative jobs are scarce, and a lost income translates to permanently destroyed consumer demand, the framework dictates implementing stricter AI regulations and higher targeted taxes to prevent a cascading downward spiral.
It's basically like implementing a dynamic speed limit on a major highway based on the weather conditions. You don't allow cars to drive 80 miles an hour during a blizzard, even if the cars are technically capable of it. You modulate the speed limit to prevent a massive pileup.
That analogy captures the mechanics perfectly. You adjust the friction to maintain the flow.
So if you are listening to this, whether you are preparing for a boardroom strategy session, analyzing long-term investments in the tech sector, or simply trying to navigate your own career path in the coming decade, the takeaway from this deep dive is incredibly clear.
Yeah, absolutely.
The AI automation wave isn't just a traditional workforce issue where some skills become obsolete and new ones emerge. The data makes a compelling case that we are facing a systemic market failure.
It is fundamentally a collective action trap.
And relying on a reactive support like universal basic income or broad sweeping corporate taxes may not be enough to stop the cycle, and according to these models, could even accelerate it. The research argues we need proactive correction. That means targeted, per-task taxation designed specifically to fund rapid retraining coupled with structural governance that legally embeds the human transition timeline into the corporate timeline.
Right.
Because if we don't fix the underlying incentives, even the most brilliant forward-looking companies will remain mathematically forced to race each other right off the edge of the cliff.
The structural cliff is visible to the entire market. But the research shows that rational corporate self-interest won't apply the brakes. The systems have to be intentionally designed to force the braking.
Well said. But before we wrap up, I want to leave you with a final thought to mull over. We've spent this time analyzing how correcting this externality requires taxing automated tasks to fund human retraining, moving displaced workers up the ladder into higher-level, more complex cognitive roles.
Right.
But if large language models and agentic AI systems continue to evolve at their current trajectory, what happens if the AI eventually becomes capable of performing even those newly retrained higher-level roles?
Oh, wow.
If there's no higher rung on the cognitive ladder for humans to climb to, does the fundamental purpose of a corporation shift entirely? Will the companies of the future exist not to employ humans to produce goods, but simply to manage massive, fully automated systems whose tax efficiencies are specifically designed to sustain the human consumer base? If the hypothetical lumber company eventually figures out how to fully automate the planting, the cutting, the milling, and the building, whose forest is it anyway?
That scenario raises profound questions about the very structure of consumer capitalism as we move deeper into the 21st century.
It certainly does. Thank you for joining us on this deep dive into the AI automation paradox. Keep questioning the consensus, keep looking at the underlying math beneath the headlines, and we'll see you next time.